Price. That's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello everyone, I'm your host Ed Gotham and welcome to another episode of Opto Sessions, where we interview the top traders and investors from around the world uncovering their secrets to success. This week I've got Austin Lieberman on the show, one of 11 portfolio managers at Chamaths Social Capital. The 11 fund managers were given $50 million by Social Capital earlier this year to try and achieve abnormal returns from the market. Austin was previously a lead advisor at Seven Investing, a regular contributor to the Motley Fool, and a veteran, having served 7 years at the United States Air Force. In this interview, we discuss how and why to invest with a founder's mentality, Austin's investment strategy at Social Capital, and 3 of his most interesting founder-led companies to add to your watch list. Enjoy. Hi, Austin. Great to have you on the show. How are you doing today?
Hey, Ed. Doing well. Thanks for having me. Love the work that y'all have done with the newsletter, the website, podcast, YouTube channel. And, you know, every time I get a chance to come on somebody's podcast that I think is doing good work and helping educate investors and spread financial literacy, I just like to thank them for putting out good quality content. And so, yeah, I'm doing well. Thanks for having me. Thanks for the opportunity. And then thanks for what you do to kind of spread financial literacy and help the world learn about finance, investing, and things like that.
Oh, thanks very much. Yeah, I mean, it's made by having people like yourself on the show, basically, because you're the guys that are, on the front line doing it all, and we can share that knowledge with everyone else. So happy to do that. Where are you calling from today?
Yeah, I'm in Jacksonville area of Florida, which you and I were talking a little bit.
Oh, nice.
We got quite a time difference. It's like 10 in the morning for me, and I think it's just after 3 p.m. for you.
Yep.
So yeah, I'm in Jacksonville.
Is that hot this time of year, or what's it like?
To me, I grew up in Florida. It's absolutely beautiful out right now. And it's, still probably in the 80s, maybe upper 80s. Honestly, I don't even look at the temperature every day. So probably hot to a lot of people, but I love Florida all year round, even during the summer. But this time is when it just starts to get absolutely beautiful. I've lived all over the place. I lived in Washington State for a while, and just miserable being from Florida and growing up in Florida, just miserable all winter long because it's freezing cold, it's gloomy outside, and then here you can still swim basically in December and January.
So do you not get much of the seasons in Florida then? It just stays sort of hot year round?
Yeah, it's pretty, for most places around the world, it's pretty much like summer and maybe spring all year round. But other than that, the leaves don't change colors around here.
Yeah, okay.
They don't fall off the trees. Yeah, it's pretty much one season all year long.
Yeah. We're just about going into autumn. Well, we are definitely in autumn at the moment, but it's been really hot here. So the trees haven't really lost their leaves yet. It's been a bit of a hot autumn here at the moment. Don't know if that's global warming or nobody ever knows in the moment what exactly it is, or it's just a strange few summers we're having. But cool. So I thought we could start by just going into what you mean when you say, I invest with a founder's mentality.
Yeah, so it's kind of 2 or 3 dimensional. Haven't counted the dimensions in my head, but I guess we'll figure that out as I talk through it. So when I say that, I mean, as an investor, I like to try to invest with an ownership mentality. And you can kind of interchange founder's mentality and ownership mentality, right? But just the idea, and Warren Buffett, a lot of people have talked about this, right? This isn't like my idea, but just the concept of when I'm investing in these companies, I'm looking at it as a company, not a name or a ticker or something that I just want to own temporarily and then trade out of. And I want to be a part owner, because that's literally what you are when you invest in the shares of a company, albeit a very, very small percentage part owner, but you literally become a part owner of the company. And so when I think about investing like a founder, it's investing in companies that I believe in products that I believe in, that essentially are companies that like I would love to work for if I was out there looking for a job. And so that's on kind of like my side as the investor, that I try to have a founder's mentality. But specifically what I like to look for are companies that are led or at least have ownership interest from the founders, the people that started the companies themselves. And there's a lot of reasons for doing that. And really, if we think about this outside of investing terms, right? So if I just go back to my life growing up, so playing sports as a kid, I was in the military. I was on active duty in the Air Force for 8 years before being here at Social Capital, which we're going to get into. I worked at a consulting firm and then kind of a internet technology startup for 2 years. And at every stop along the way, industries were different. My job was completely different, but like the one common thing that really heavily influenced the outcome of whether that sports team, my military teams, the company I was at, if they were successful or not, was leadership. And then take that to investing, right? So when it comes to investing, we've got to decide kind of what bucket we fit into. Are we traders or investors? And in my opinion, the differentiating line for that is kind of like your average holding period. If it's over a year, in my mind, I consider that an investor. If it's under a year, that's more oriented with trading. Not to offend anybody, and I'm not like sending any judgment. There's people could be effective at both, right?
Yeah.
The reason I think about it with that 1 year kind of time frame is because if we're investors and we're interested in a year or longer, then those leadership qualities that I kind of referred to that matter in all things in life, and then execution really matter, because that's what's going to dictate the general direction of the business over time.
Yeah.
Completely separating that from stock price, that's going to have a big impact on the business over time. And so then if we decide that leadership qualities matter, then we have to figure out how to invest in companies with leaders whose incentives are most aligned with shareholders. In my opinion, the best way to do that is to find aligned incentives, and then to make sure that the leadership teams have skin in the game, or a high level of their net worth, or time invested, and passion in the company. And so the best way to find that is generally when the founders are still either involved on the executive team or they're on the board of directors, and they have a relatively high level of their personal net wealth tied up in the outcome of the company. And when you find that, and the reason that I like these founder-led companies is because it generally they're oriented towards doing things that are good strategically for the company for the next 3 years, 5 years, and 10 years. And it's not perfect. There's a lot of like really bad founders out there and in scams and stuff like that. But it's just a good filter to start to find leadership teams that are incentivized to build the business to perform well, which then, in my opinion, the stock price eventually follows the business over time. And just as a quick example, and we're going to get into these, right? But there's a couple companies that I'm invested in. The first is Elasticsearch, and their executive officers and directors they own 20% of the shares outstanding. And then Inari Medical, another example, their current executive officers and directors own 23% of the shares outstanding. And so when you see that, that is most of their net worth tied up in these. And then of course they're going to sell shares over time and things like that. But really long answer here. We can get into how we can figure out, those levels of ownership and if the founders are still involved and things like that. But what I really care about is long-term thinking, and then having the management team incentivized to do well long-term, not just, a quarterly bonus or something like that, which is sometimes what happens as companies get larger. And the other thing that, founders being involved with the company, generally that means the company is still under a certain size market cap, which again is a good filter for just the growth opportunity that could be ahead for the company. Elon Musk is not technically the founder of Tesla, but for all intent and purposes, he's the founder of Tesla. And then Jeff Bezos with Amazon, who's, he's obviously left the CEO. Those became absolutely massive companies with the founders essentially still involved, right? But those are the exception and not the kind of the average. And so on average, when you look at founder-led companies, they're still a lot smaller than those, mega caps, which that's the ground I love to look for, because there's a lot of upside. Not that there's anything wrong with Amazon or Tesla, that, very proven great companies. Tesla, maybe not in a lot of people's opinions, but think it's a complete scam or whatever. But it just, founders being involved is a great filter in my opinion for a lot of things.
And what is a good percentage ownership then that signifies to you they've got skin in the game? A little bit related to value as well, I suppose, at an earlier stage.
Yep, exactly. So the younger and smaller market cap of a company, you would expect the founders to own more of the company, because owning more of a $10 billion market cap company, say you own 10% of that, that's $1 billion of your net worth tied up. It would be, I don't know what the numbers are, but it would be unrealistic to expect a founder to still own it. Maybe, I don't even know this number. We could look it up, but maybe Jeff Bezos still does own this. But it'd be unrealistic to think that one person still owns 10% of a $1 trillion company. It may happen. I don't know. Like, honestly, I don't even look at the ownership of those companies because they're so big now. But as a company gets larger, generally, just in their plans, in their estate plans or financial plans or whatever, the founders are selling off shares every month, and whether that's for charitable purposes or own purposes, whatever, you just expect them to sell off over time, but then still own, a large dollar value of net worth. And if a company's under, say, $50 billion in market cap, then even a founder owning 1 to 5% of the company is still a big deal. So really it varies with the size of the company. And we can just go with that. If it's under $50 billion market cap, I like to see the execs at least own, 5 to 10% of the shares. It's not always required either. Like, I own some companies that the founders aren't involved anymore. But you can still find these traits, the long-term strategic thinking and planning that I believe make founder-led companies attractive in some non-founder-led companies. So, I will own companies that the founders aren't involved in, but no matter what, I still look for that long-term strategic thinking, not like quarter to quarter, what's the news release or the press event that a CEO could do to temporarily boost the share price, And
then digging deeper on the reasons why founder-led companies are successful. We've talked about having the incentive right, which is owning part of the company, so you benefit from the success of the company. Is there something more than just monetary sort of reward there that makes it? Because you could argue that when the founder leaves, some people still have ownership, but it may lose its way compared to something that's led by a leader or founder who really believes in the business and what it's trying to achieve, like some sort of goal that's more than money. Is that fair to say?
Yeah, definitely. And so aside from the financial interests that founders may have, they also, when they start a company and it's private, they're essentially starting a company because they're ultra passionate about maybe it's a completely new category that they're creating, which essentially, if you think about Amazon, right? Like, they essentially created for the purposes that we look at it, they essentially created e-commerce, at least at the scale and the form that it's at today. And when they do that, that means that they've probably got a lot of experience in either the same industry or dealing with things in that industry, and they've identified a problem. And whether it's with Amazon, whether it's like this consumer need is not being met, and the experience is just really bad. So we're going to go create this thing that serves this need and meets this unmet demand, and then disrupts the old way of doing things, which may have had high fees or a bad experience or limited supply. limited choice, whatever. Or they've, there's, Amazon was an example of like a brand new category, or they could work. Zoom is an example of this. That the founder, Eric Yuan, worked at, I think it was Cisco, and just got frustrated with the legacy way things were doing them, a failure to innovate, or bad customer experiences or whatever. And then they come out and they start something in the same industry, but doing it a different way that they think is, again, a better experience, faster, more efficient, cheaper, whatever. And so when you start a company and you have that passion, you have that mission, like a mission focus, a lot of the people that join are going to be dedicated to that mission or that purpose as well, especially early on. And then as you go through the rounds of being a private company and become a public company, yeah, sure, some of those people are going to leave, but you start to get this reputation of being a disruptor or an innovative company, a fast-growing company. You're disrupting some of the legacy providers. And it's almost like an arming the rebels type of thing. Shopify says that a lot, right? Like arm the rebels, and they're powering this whole generation of digital store owners and e-commerce sellers. What you start to build is just a company that's oriented around this mission or this purpose of doing something and serving a subset of customers or society or whatever. And you get people that are really dedicated. And then that compounds, right? As the company starts to see success, they start to attract more and more talent. And maybe that talent is some of the best up and coming developers or engineers in the world. And then because they're attracting that talent, the company's going to do better. And then as the company is going to do better, they're going to attract more talent. They're going to be able to pay better. They're going to have, more positions. So I'm kind of like getting long-winded here, but the point is that the founders set the mission, their incentives are aligned, and then they start to build a culture of kind of like-minded people focused on that are like obsessed with this one thing. Mm-hmm. And then it just scales and scales and scales if it's successful.
Yeah. And how do you go about finding percentage ownership of the execs and stuff? Do you use some resource for that?
Yeah. And so there's a couple like free resources that you could kind of, I guess, like speed this process up a little bit, right? TIKR, and I have no relationship with them, whatever. It's called like Ticker. And I think it's free to sign up. You can go in and there's like an ownership tab on that site where you can look up any company. Nice. And see the fund owners. So if like a ETF or a hedge fund or something like that has a large percentage ownership, you can see that, but you can also see the individuals. It's weird, like as an investor and really just in life, there's times where it's like you need to do things fast and efficient. But there's also times where not going as fast as possible can actually produce better outcomes. And this is kind of potentially one of those areas. The other way you can do this, and this is how I research companies, is kind of just like bottoms up, right? Or not necessarily looking across an entire industry, or not looking for a certain attribute of a lot of companies, but just going company by company and kind of researching and learning about them. And so every company, if you go to, that's a public company, if you go to, Google their name and then after it put investor relations, just by law, they have to have SEC filings. And so if you go to their investor relations page and then SEC filings, and it's the form DEF 14A, I think they have to do it every quarter. And then specifically this section is security ownership of certain beneficial owners and management. And right there, it's literally listed, the number of shares and the percent of shares outstanding that they own. And then it also summarizes in total what the executive team owns.
Brilliant. That's going to be very useful. And finally, just maintaining this founder-led sort of discussion. What are your 3 favorite founder-led companies that you're sort of following today?
So I don't know if these are necessarily my 3 favorite, but they're 3 that I own and have, confidence in over the long term, which for me is like 3 to 5 years. I have no idea, what's going to happen in the next quarter or next week with these companies. But there's a company called Elasticsearch, which just in very basic terms is a search company, and not a search company where you go on the internet and try to search and compete with Google, but more of an internal search company. And a good example of how to think about what they do is they think everything is search, essentially, right? And so one use case is if you have a person using the Uber app and you have an Uber driver, when that person using the Uber app needs a ride, and they put in that they're looking for a ride from here to here, that's a search that needs to happen. There's technology behind the scenes that needs to do all these calculations and figure all this out, all this routing, and connect them with the driver that makes the most sense based on what the driver's doing, where they're at, all of that. And so when I say a search company, that's what I mean. And so then when you think about that, there's every company's got databases and all kinds of things that they need to be able to search, or an application similar to an Uber or something like that, where they're connecting individuals based on certain aspects. So that's their function. It's considered like a hyper growth company. They've grown from 45% year over year to even 65% or faster. I think they're growing in the high 40s or low 50s now. And I don't know if I said this at the beginning, but they've got, I think I did, they've got the executive officers and directors own 20.4% of the company. The founder and CEO, the primary co-founder and CEO, Shay Bannon, owns 9.3% of the company. And just to give you an idea of how large that company is in terms of market cap, back to kind of that, like, hey, what percent matters? It's a $15 billion market cap company. So if you think the CEO owns, about 10% of it, that's $1.5 billion. Yeah. Which is, I would guess like most of his net worth. And so, they're just incredibly an innovative company. Another one is Inari Medical. And I wanted to talk about some companies that, maybe a lot of people haven't heard of. It's easy to hear about, some of the more popular companies. Inari Medical, essentially, they've created devices they've developed devices that are specifically for treating pulmonary embolisms. And so they've got two devices that are specifically cleared by the FDA for that. And their claim is that every other device has been repurposed from like another use case to doing that. And so what they're able to do is they're able to make these procedures a lot quicker. Patients, they lose a lot less blood, and they don't need thrombolytic drugs, which are when you go in and you have these procedures to essentially remove clots, right? With previous devices, just because they weren't specifically designed for this purpose, patients also had to use drugs a lot of the times to help kind of get the clots out. And with those drugs came risk of bleeding. And so I'm not a medical expert, but just the research that I've looked up, that makes these procedures a lot more risky. And so with Inari's, it's called a flow triever and the clot triever, they're able to do that without using those drugs. And the procedures are a lot quicker, which is less risky for patients, according to Inari and some of the data that they've put out. And it's better for hospitals because it's a quicker procedure. Patients generally don't need ICU stays or as long of ICU stays as other procedures. And so just, to me, that's really exciting because when you talk about a mission, right? Like the people that joined that company, before it was even public, are probably really passionate about trying to improve the outcomes for the patients that they're treating and save lives. And a lot of them, even the CEO share stories all the time of either employees or family members or whatever that have gone into a hospital and potentially with life-threatening conditions and basically like walked out 5-6 hours later after having these procedures. So the execs own 23% of that company, and it's last I look, I think it's like a $6-7 billion. It's a $4.5 billion market cap company.
Oh wow!
So a lot smaller there, a lot earlier.
Mm-hmm. What's the ticker for that, Austin?
NARI, and Elasticsearch is ESTC. Nice. And then, this one is going to be a little bit more popular with people, but Spotify. There's a lot of debate around like whether Spotify, the whole licensing and fee structure and whether they can keep that up or if they're going to get, margin pressure and how much all that can expand. They're just a basic like thesis for Spotify, right? It's just that they're going to attract millions of more listeners, and they're going to attract hundreds of thousands or millions more creators through whether they're music artists or now, podcasters. And then if they're going to be successful over time, the bottom line is just they're going to have to figure out how to continue to monetize both sides of the business, which is kind of like the music side and then the podcasting side. And advertising is becoming more and more a part of it. And as both sides of those businesses grow and that kind of like network effect takes place where more users attract more artists and more artists or podcasters attract more users, and then all of that attracts more advertisers, it's just going to continue to be beneficial for the business. And so Patrick O'Shaughnessy on Invest Like the Best, and then maybe Founders Field Guide, he's got this Colossus family of podcasts. If you search Invest Like the Best and Daniel Ek or Spotify, whatever, he's done 2 interviews with him now. And if you just hear him talk, you can hear the 10 to 20 year mindset that he has of how he thinks about growing the business. And essentially, he's just adopted this idea that they're going to power and empower creators. And I'm of the opinion that we are in the creator age. And I mean, we're doing it now, right? On this podcast, people can now so more than ever make very real careers and livings off of this stuff, or just it's easy enough now to do it on the side to where you're just making, maybe a couple $100 a month or whatever through a podcast and advertising. Well, when you multiply that by hundreds of thousands or millions of people, that's a significant business, right? And so I don't have those numbers in front of me, but I think Daniel Ek and then a co-founder who is still on the board, but I don't think he's on the exec team. Between the two of them, they own 20% or more of the company, and that's the largest out of all of these. Out of all 3 of these, they're sitting at a $48 billion market cap.
Wow. Yeah, it feels like there's a lot of room to grow there. It just getting started is from what you're sort of saying and how he's sort of looking at it. Have you got any? Have you heard how the podcasting element of the business has been going? Because it's relatively new, isn't it? And I know I listened to a few on there, but I've not seen stats yet. I think they're reporting this week or next week, potentially.
Yeah, I'm trying to look it up right now, just because I don't want to say wrong numbers. So I don't have the exact podcasting numbers in front of me, but the reason that the podcasting side of the business is important is because that attracts a lot of advertising dollars. And so the advertising metrics are kind of a good way to gauge the success of podcasting, right? And so right now, advertising is about 10% of their business. And in one of their most recent investor presentations or interviews, the CFO said, they're confident that that's going to continue to grow. And then what's been the holdup for Spotify in the past is gross margin, right? How profitable is it even possible for this business to become? And right now, gross margin has been about 25, 26%. And that has a drag from podcasts because they've invested a lot in going out and getting these exclusive
mega names
contracts, right? They think that their target over the long term is to get that gross margin to 40%. And the way that they think they're going to get there is that the podcast segment, there's improvement on the music side of the business, but more significantly, that podcast segment goes from being a detractor or taking gross margins down to significantly benefiting gross margins. And so what that speaks to is just the relative success of the growth that they're seeing in podcasts. And I think they even said, and I don't have this quote sitting in front of me, but basically the podcast side has done better than they were initially expecting thus far. So the drag on gross margins has actually been a little bit less than they were expecting. But that just gives them more confidence in kind of the upside and that they've made the right strategic decision with podcasts.
Yeah. Yeah. I mean, I think I mentioned briefly, we've explored it for this podcast. And we have we do run advertising, I think, on Spotify at the moment, and it definitely is quite cost effective in sending traffic and followers. It definitely works, and it just needs to be made. It's almost like it's in beta at the moment. It may actually be in beta, but they need to sort of build it out so it's more user friendly to create ads and target certain, audience and stuff. But you can just see how it's got potential there. It should be very interesting in the next year or so.
Yeah. And they also shared. So let's see, I do have this. Something like, it's a crazy, I want to say, and this is off the top of my head, actually, I think like 80% of all new podcasts are started on Anchor, their podcast platform. I'm trying to look that up. So the CFO, this was on September 14th, 2021, and this is at the Bank of America Media Communications and Entertainment Conference. Having a platform where 80% of new podcasts are created helps drive the market, and it'll be really helpful. So yeah, back to that question of like, how are the podcasts doing? Apparently 80% of the new podcasts being created are there. Now, a lot of those probably don't last more than a couple episodes, but still they've become a major force in this industry, which is pretty impressive when you think about the lead that, people don't create podcasts on Apple, but I've created podcasts before, and you used to have to host them at like Libsyn or, some other third party site or something like that. The Anchor experience just makes it so easy to host it, to turn on advertising if you want to create your podcast in segments. It's very user friendly and in like eye pleasing way to do it. I don't know if you guys use Spotify or Anchor or not, but you definitely should, as a shareholder.
Yeah, we should look at that. We actually don't.
I think you should.
Yeah, we use something else.
No bias. I don't have any bias, but you definitely need to use Anchor.
That is interesting. I'll definitely check that out after the show.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
So I thought we could now just move on to just talk about a little bit about your background, because you had quite an interesting career, and what eventually drew you to the world of investing, and how you got into social capital as an LP.
Yeah. So just one quick clarification. I'm not an LP. I just want that to be out there. I'm part of the emerging portfolio managers class. So essentially we're portfolio managers for the company, but not specifically designated as limited partners of the company. But yeah, my path has been pretty direct, and it makes total sense that I'm in the finance world. If you don't know me and you're out there listening, you don't know that I'm being 100% sarcastic right now. I've had a path that it makes almost zero sense that I'm involved in a level of, a professional level of investing, if that's what you want to call it, being a portfolio manager. I started college at a private Division II school, which is kind of like I guess you could say like a small to medium sized university, on a 50% baseball scholarship. But it ended up just being not good financially for my family. And so after the first semester, I left, went back home, finished that year at community college, which is like, local college in my hometown. And then started my second year, so my sophomore year of college at the University of Central Florida. And while I was there, I tried to walk on to the baseball team there, didn't make it. But I started up Air Force Reserve Officer Training Corps, which is just a way to go to school. But while you're at school, you're also kind of learning and taking the classes that you need to commission or become an officer in the Air Force when you graduate college. And so I did that. I finished college in 2011, and then spent 8 years or 7.5 years on active duty in the Air Force. And we lived all over the place. We lived in Georgia. We lived in Washington State. We lived back in Georgia. And I spent time and just a lot of different places. We traveled all over the United States for training. Spent some time in Kuwait and Jordan and the UAE. I think done some training and stuff in Canada. So just really a really cool chance to experience the world and like learn from different people and different cultures and get some of that experience. And in 2011, when I was a senior in college, you have the opportunity to get what's called a cadet loan, because by that time it's pretty clear that you've done what you need to do and you're going to be able to commission as an officer and you're going to have pretty secure pay. So they know that because you've been involved in kind of this ROTC stuff, which takes time, possibly or likely you haven't had a chance to really like work a job and you might not have a bunch saved up. So there was a loan, and back in the day it was like, I don't know, 2.5% interest or 2.2% or something like that. You get it's a $25,000 loan, and it's designed to like help you bridge the gap from when you graduate college to then like starting to really your last year in college as you prepare to make the move and get your life in order, to then moving to then really getting your pay established and things like that once you start on active duty. That's what it's designed for. I spent a lot of it on, we went on a cruise my senior year. I used it to buy the engagement ring for my wife, which I'm still married, so that fortunately was a good investment. Bought 2 road bikes, and then I had like, I saved some of it for like moving expenses and stuff, but then I had like, I don't know, $8,000 or $11,000 or something like that left over. And I was watching Jim Cramer and thought that I was going to, make a bunch of money and become an investor. And I would literally just like buy whatever he was talking about that night. And quickly learned that like, that's not the way that you invest, and that's not how you be successful. Right. And so kind of turned me off to it. But then I moved around, and as I got to my first real duty assignment after 2 years of training, essentially, so this is like 2013 timeframe, I met somebody that was kind of like senior-ish in their Air Force career. And he was just talking about how he had owned Netflix stock, and he was up something ridiculous, like 6,000% or whatever. And he had turned, whatever, a couple $1,000s into $90,000 or $100,000. I don't remember the exact math, but it was like life-changing for him. And I started to wonder like how that was possible. And so he just told me he was a Motley Fool member, specifically like a stock advisor member. And so, and if people are not familiar with Motley Fool, it's essentially it's a massive company. They've got all kinds of free articles out there, but then they've got a paid side of the site where you can subscribe to various different investing newsletters, essentially, where you get monthly stock ideas. And Stock Advisor and Rule Breakers are kind of like their most basic level. And that's what he was a member of. And so I became a member of that just because I respected him. It worked out for him. And that's really where I learned how to actually invest versus the, Jim Cramer trying to get ratings and having to talk about the popular stock of the day and the movement every day, to the Motley Fool, which once you get past some of their marketing and their free articles that are there for a purpose, right? They drive views to the site, and then they truly believe in their product. And so they know on the internet, you got to get more views to get premium signups. And so, they kind of play that game too about getting the eyeballs on the free side of the site. But then just in my experience, like truly a phenomenal experience being a member to Stock Advisor and Rule Breakers, because you really just learn how to evaluate these companies. Really just during the rest of my military career, kind of managed my own money and got a little bit more involved with the Motley Fool. I did some freelance writing with them from 2015 to 2020. And I did that just because the way I learn when I do things is just like in my opinion, the best way to learn is like take part in it. Right. And so there were some opportunities that I could use some of my free time while I was in the military to do a little bit of writing for them. And then really just adopted the kind of the rule breaker mentality that David Gardner has. He's got a podcast called Rule Breaker Investing, where he talks about all these traits of finding great companies for the long term, and just kind of adopted that mindset and then applied it to my own investing style. Got out of active duty in 2018. I had been gone away from family over 50% of the days from 2011 when I joined to 2018, and sometimes for up to 7 to 8 months at a time. And it just kind of like wore on us, right? We were at a point in our lives and in our where we wanted to prioritize spending more time together as a family. We had kids. We had a miscarriage, which was like really hard and kind of like really reoriented us as a family, and reminded me that, hey, you get one family. And as proud as I was of being in the military, like I just knew that my wife needed me to be there more. I needed to be there more. I needed her more. And I'm sharing all this to just share that like that's what investing did to me. And so whether somebody listening to this podcast is not interested at all in like the professional or becoming a fund manager or anything like that, investing, like in my opinion, especially moving forward, like everybody is an investor. When crypto is more popular, like it's easier to become an investor than ever before, but it's also easier to go down that path of like the day trading and all that stuff than ever before too.
Yeah.
And so the takeaway is just that like that act of living below our means and investing gave us the optionality for me to make that decision in 2018 and leave the military, which was like my primary source of income, and then go and do things. And so at that point, I started a newsletter where I was just like sharing my portfolio, my returns, all of that. And so I really did that from like 2018 to 2020. And then in 2020, I was one of the first lead advisors of Seven Investing, which is essentially some people that had worked at the Motley Fool, specifically the founder and the person that like put his own money behind it to start this whole thing up, was Simon Erickson, who's phenomenal. Highly recommend you get him on this podcast. He's a great investor, but also like a great business person. And so a lot of cool lessons there probably. But I was lead advisor there. And essentially what we did was we adopted that model of subscription service where people pay monthly for investment ideas, and did that. And then I saw Chamaths. I was a fan of Social Capital and a fan of Chamaths and just the way that he thinks and his vision and long term, and just his upbringing and the things he's overcome. Just all of that stuff is very inspiring to me. And saw him tweet. I think it was in like October-ish, September-ish of 2020.
I think I saw the same thing. Yeah.
Yeah, they were gonna do this new initiative. And I was like, this is ambitious. Like, I'm not sure I would get picked for this, but I'm gonna apply anyways. And that's something that I've rambled a lot in this, and I know we're gonna talk about kind of like the military stuff. That's one of the things I learned throughout the military is just like, go do things that you're not sure that you can do, and be confident in your ability to learn things, and then your work ethic to get in there and like work as hard as possible and be as curious as possible and learn as much as possible. You're never going to know if you don't try it, right? And if you do try something and you don't get it, then you're usually going to be better off for trying it, because you've grown, you've met people, you've networked, whatever. And then you might just surprise yourself and like achieve this crazy thing that you knew it was, just percentage wise, it wasn't likely that you were going to succeed at, right? And so, I saw that and was like, there's no reason not to apply for this thing, so I'm going to do it. And then to, Simon's credit at Seven Investing, he was just completely supportive, right? And I was like, hey, I'm super passionate about what we're doing here at Seven Investing, because this is, for one, a very small team, and like our livelihoods were kind of dependent on each other because there's a brand new business. Simon had invested, a lot of his personal capital in it. And so it was hard to like leave something like that. But, Seven Investing was doing just fine. Simon was super supportive. And if you have an opportunity, like the opportunity that I have, that was present with Social Capital, and you're interested in being a portfolio manager and managing money, like you're crazy not to take it. And I mean, Simon told me the same thing, right? So yeah, the whole point is like super unconventional, right? But like these opportunities are happening more and more. And the way that, I think I was able to be a candidate for something like this is because I was out there on Twitter and just like sharing my investing stuff and kind of like building a network, but also that people now more than ever are like valuing diverse backgrounds and diverse opinions. And so my experience in the military, although not like I have a criminal justice degree from Central Florida, so nothing finance related. These diverse backgrounds are like important for adding different value in different ways to different teams. And then the experience I had in the military and critical thinking and risk management and all that.
Yeah, it's a great story. I definitely believe the internet has opened up opportunity. But, there's a lot of bad things about the internet as well. But the good thing about the internet and technology is that it has definitely opened up opportunity to the masses. Yeah. That's great. I mean, it's a really interesting story. And we've touched on it already with your founder-led sort of philosophy, but if you're going to take us through your investment philosophy holistically at Social Capital as a portfolio manager, is there any other things that are involved in addition to that? Like if you just summing it up.
Yeah. So I'm just trying to think of the best way to, I guess, like kind of sum this up quickly, right? So, as an investor, whether investing as like an individual investor or managing a portfolio, I think you've got to figure out what you think your edge is, right? Or you're like, what is your competitive advantage that's going to allow you to succeed and be better than average? Because if you think about it, like most people are either average or they do worse than average because that's how averages work out generally, right? And so for me, what I've realized over time is that the important thing for my success as an investor when I was just an individual investor was the ability to have a long time horizon and find these companies that are building great products. And you can see that by kind of the fundamentals. What's their sales growth? What is the net retention rate of customers? What is the average revenue per user, or dollar-based net expansion rate is like a common term for SaaS companies, which essentially just means customers that they currently have, are they spending more each year than they were before? What's the growth of customers? That's how you can tell if a company has like a truly great product, and if they continue to innovate. If those things start to fall off, if their growth starts to fall off more than would be expected from just revenue getting larger and larger, or if their gross margins start to fall off or whatever, those are often like indications that something is slipping in customer satisfaction. So maybe their products aren't as good, they're not innovating as good, maybe there's a competitor out there or whatever. So finding companies with great products that are in important and growing industries, and again, like this is all straight out of the David Gardner book, right? Of rule breaker investing. But then a lot of people can do that. Anybody can do that. But then, and this is again, the differentiation, that 1 year thing, the differentiation between investing and trading, but then having the time horizon and the ability to withstand volatility, to let those ideas play out. And that's how you're able to be invested in something like a Shopify or the Trade Desk or Twilio or even Amazon over time. Every single one of those companies has had 30%, 40%, even like maybe not all of them, but I know Amazon has had 80 and even 90% pullbacks over time. So for me, I knew that I had the ability to find these companies early, but I needed the time horizon to let them play out and invest in them long-term enough. And one of the awesome things about the opportunity at Social Capital is that they give us that opportunity. They encourage us to look for those long-term opportunities and long-term time horizons, which is, I've never been a portfolio manager anywhere else, but just reading and learning, a lot of times portfolio managers see short-term pressure from investors that maybe want their money back after poor performance or whatever, and so I know that that's, if I'm going to do well, that's how I'm going to do well, is finding these companies and then having the ability to hold them long-term. And so then you got to figure out how to find them, right? And so just to branch it, like I essentially have a scoring checklist or a way to score these companies and come up with a score that's a quantitative score. There are some qualitative factors in there, but essentially I get a quantitative score. And what I look for is just finding the best 25 to 35 companies. And essentially like that's the pool that I keep, that I know that I want to be invested in. And then once I'm able to find those companies, it's then figuring out, okay, is this a good buying opportunity for the company based on, the current multiple, current valuation, and future growth potential, and then some of the common volatility, and that's where, as on this side as a portfolio manager, I've had to focus a lot more than when I was an individual investor. The best thing I could have done as an individual investor when I was out working my job is every 2 weeks when I put money in, just invest in these companies, and then never put too much of my money in any single company, because I didn't have the time to spend and watch news reports and every earnings report, because I was out working a job, right? And so what's changed is that now this is my primary focus, and I have a lot more time to be able to focus on, hey, finding the right entry price, making sure that the positions are sized correctly, and then just managing those things over time. And so just quickly, like the things on my checklist are financials, the business model, how do they go to market? How do they grow? One of the things I look for in a business model is the ease, especially in like software companies, the ease of customers signing up. Can customers go and self-serve on the website and sign up for the product versus having to schedule a call with the team? And then, those are longer sales cycle. I really loved like the developer self-serve cycle, which Twilio is a great example of that. The moat. So like how defensible is their business model, and are there reasons that a competitor can't just come in and steal their customers away? And so things like that.
How do you go about defining the moat? How do you know if something's defensible or not?
Yeah. And so this is what, in my opinion, has been a huge change over the last 10, 20 years. A moat used to be kind of like high capital expenditure costs. So if you think about it, Coca-Cola, oil companies, railroads, people that had to go out and invest a lot of money to build out some type of like infrastructure or logistics, supply line, whatever, because it was hard for somebody to come in and replace that. What I think has changed, and I really focus on like software companies and technology companies, is now high CapEx costs are almost like a negative, because that makes it very hard to change your business model and adapt and innovate over time. And so now, in my opinion, an indicator of a moat is continued revenue growth, continued customer growth, continued either average revenue per user, or dollar-based net expansion, like we talked about. That's the amount of money our customers spending more every year. And then either stable or improving gross margins. Like those are indicators. And then we think about what makes a moat or a business model defensible. And so I'm just trying to think of like a good example off the top of my head. Let's see. So we could talk about even Spotify, right? Yeah. So even with Spotify, they've essentially built up like a three-sided marketplace or a three-sided platform. And I talked about that network effect earlier, where they're trying to attract more listeners, more creators, whether it's music labels, artists, podcasters, and then more advertisers. And so as they build that up, it kind of feeds upon itself, where when they attract more listeners, they're going to attract more podcasters or more creators. When they attract more creators and more listeners, they're going to attract more advertising dollars. And so that makes a platform like Spotify, you can't just go and start a brand new Spotify and begin taking market share from them. It's definitely possible to, but as that scale and that platform gets larger and larger, it becomes harder and harder to take business away from them. And by the way, they're bringing in more revenue that they can then invest in research and development or marketing or wherever they need to invest it, or bringing on more podcasters. That makes it even harder. So Spotify is an example. I should have had another one ready off the top of my head, but
and that's good. It makes sense. I think it's because it's an interesting metric. This sort of moat thing's got very popular. This defensibility essentially, isn't it? But it's a really good one that people keep in mind, isn't it, nowadays? Because companies can be created and get popular so quickly. You do need that moat. Otherwise, you can be displaced. What are some of the disruptive themes you're interested in today? I think, for example, you've mentioned ad tech in your Substack.
Yeah, so ad tech is one for sure, and so it's an interesting time to talk about ad tech, right? Because just last week, and we're taping this, I'm not sure when this is going to come out, but we're taping this on Monday, October 25th. Just last week, Snapchat reported earnings and got absolutely demolished, down like 25% or whatever. Some of the commentary was around some changes from Apple and their kind of privacy policies affecting advertising and the way that essentially companies can like track user data and then essentially like target advertising. But then they also mentioned supply chain issues having an effect on advertising. And so with that, it wasn't necessarily this quarter, although this quarter wasn't like perfect, but I think the thing that like really spooked people or changed the sentiment was the guidance that they gave, which was just, below what essentially like Wall Street, what analysts were expecting in almost every metric for next quarter. And I mean, the stock was trading at like a pretty high multiple. So if you still look like over time, the stock's still doing fine, but it just got basically 25% haircut last week, which is a big deal. But with that, a lot of these like ad tech companies sold off.
Yeah.
And so,
Turbine.
Yeah. Yep. Which, yeah, I'm a shareholder of Digital Turbine. And so, just very broadly, the idea of programmatic advertising, which is just advertising through digital means that can be automated, essentially like bidding and sale versus kind of previous ways, which was linear TV, where humans intervene and it's just a lot more steps in between than being able to do it all digitally. And connected TV. So when we talk about connected TV, that's like TV you watch over the internet. That has, over the last 5-8 years, started to really eat into the advertising dollars spent on linear TV, which is just like old school television. And then with that, there's been the rise of some of these applications, obviously Facebook, Google, Snapchat, Pinterest, different platforms like that. And so they've obviously built some pretty strong businesses. I don't own Facebook right now. I don't own Google. I don't own Pinterest. I don't own Snapchat. Those are, great businesses, but I think I have a thesis that advertising budgets are now more nimble than ever because they've moved more digital, and like the programmatic buying aspect of it has made it a lot easier for these marketing teams to kind of like adjust advertising as they need to. And so where I think we're at is the age of people being able to move money away from some of these like walled gardens, which if you think about Facebook, that's considered a walled garden in advertising, because when you advertise on Facebook, you're advertising to Facebook and Facebook properties, not to the rest of the internet. Like if you're advertising on Facebook, somebody has to be on Facebook to essentially see your advertising. I think incrementally we're seeing like advertising dollars move away from that to more essentially like the rest of the internet, right? Or the rest of mobile. And so two companies that I think are positioned well are Magnite, which essentially just operates in the connected TV space of advertising. So that's some of that money that's moving from traditional television over to streaming or internet TV. That's why there's more behind it, but for the purpose of this podcast, it's like that's the big movement there, the big disruption there. And then Digital Turbine, which is essentially like a mobile advertising platform, and they've kind of rolled up some other companies, but they serve a lot of phone customers, and advertisers on the Android platform of devices. And so when you look at phones throughout the world, most of them are Android devices versus iPhones. And a lot of the advertising dollars obviously are either still in linear TV or on Apple or whatever. And so some of these privacy changes that we're seeing with Apple, in my opinion, actually benefit somebody like Digital Turbine, who serves customers on Android devices across really any application that they're using, versus just being able to go and advertise in Snapchat or in Pinterest or in whatever. So yeah, digital advertising is one that I'm invested in right now. There's some disruption going on, and I like the movement of, or I guess you could say, the freedom of ad dollars in the flow, even incrementally. Facebook, their businesses they're not going anywhere. But even if a very small amount of their revenue moves from Facebook to advertising across like somebody like Digital Turbine's platform, that's a monumental change for Digital Turbine just because of the size of the company. A couple other ones, gene therapy and really just like biotech technology. That's a tough one to invest in because you got like FDA risk if you're investing in somebody that's like doing some novel drug or novel treatment.
Yeah.
I own a company called BioLife Solutions that essentially provides ways to like cold storage and ways to transport, whether it's different therapies or different like testing results or whatever, from either testing centers to the like testing sites, or from drug developers to like medical facilities or testing sites and things like that. So essentially they're helping the logistics and preserving some of these different tests and different like therapies and things like that. Yeah. And so, I like a company like that because you don't have a single risk like of FDA clearance if something goes wrong with a drug or a clinical trial or something like that. Really, it's like a picks and shovels provider to that entire industry, which is estimated to grow, I don't have the number in front of me, but it's like billions of dollars and double digits for the next, several years. And then, e-commerce is obviously another one, and that's a tough one because a lot of these platforms are already established. So Shopify is an amazing company. I don't own Shopify, even though I'm like really interested in this e-commerce. So there's other opportunities there. And so, yeah, those are three. And then the creator economy, right? So that's like the Spotify's of the world powering the creators. And then Spotify is also kind of an advertising place. So yeah, there's four for you there: digital advertising, gene therapy and genomics, the creator economy, and then e-commerce are kind of like four buckets that I'm excited about right now.
Oh, thanks for that, Austin. It's some interesting areas. And how much have you worked with Chamaths on the sort of developing your approach, and any insights you can give on how Chamaths approaches investing and things that you've sort of picked up and liked yourself?
Yeah, the coolest thing about the interactions that I've had with Chamaths are, and this even goes from like the interview process, is just how like genuine he's been. You had Angela on a previous podcast. I know she talked about this a little bit, but like, I don't know of another interview process in my life where essentially like I even interviewed with the CEO or the founder of the company. And now granted, I worked at like larger companies people wise, but still the fact that to even interview with the founder or the CEO of a company is not normal, right? And so the fact that he like made the time for that really meant a lot to me. But then I've had experiences where I interview with companies and like the person whose team I was going to join that was interviewing me, like it seemed like they didn't even read my application and they were asking me, but he was asking me specific questions about, and it was over Zoom, right? But like you can still feel in my opinion, over Zoom, you can like still feel the genuineness of a person, right? Like he was asking me specific questions about my family and my kids and what my wife thought about me potentially joining Social Capital, and using their names, right, which I like included in the application. But like the fact that he had put in the time and the effort to do that really meant a lot to me. So from that standpoint, there's a lot you learn about a person just interacting with them like that, and a lot you can pull from them. And maybe those aren't direct investing lessons, but just lessons about who I want to associate with, and then how I want to conduct myself when I'm interacting with other people as well, regardless of my level of business or financial success. Because in my opinion, that's just like leading by example, right? But then as an investor, and I mean, you don't even have to be in any type of private meeting with Chamath to see this. You can just like look at the times he's been on TV or the podcasts he's been on, his ability to pattern recognize and then see things that have happened before and then associate that with a company. And for example, he made like a famous call on Tesla. I don't know, this was like 5 years ago now or something like that. Just on like what the innovation looked like and what their dominance over really like it wasn't even the electronic vehicle industry, because it didn't exist and Tesla's out there like creating it, but just the fact that they were going to build this network out, invest, and then through the innovation of Elon Musk and the team, and then their manufacturing innovation, like be able to drive down costs over time. Essentially, it's just like having this long-term vision, which is exactly what I talked about, like the type of investor I tried to be anyways, but just like seeing that at a much larger scale, and somebody have that type of success with it is inspiring to me. And it's a reminder like, hey, the way that I invest, although it's volatile, you can be successful that way. And that's encouraged here if that's the type of investor I want to be. To everything from the meetings we've had with him where he really tries not to impart any of his own like views, I would say, directly on us, because he wants us to invest in the way that we believe in, because that's why he's started this whole thing, was to give different people from different aspects of life and different backgrounds the opportunity to express their views and their experiences in their portfolios over the long term. I mean, and I'm not necessarily associated with this side of the social capital business because we're focused on the our portfolio manager jobs and like the stocks that we own. But just hearing him talk about the types of companies that he's out there funding and that social capital is out there funding that are like truly trying to do great things in the world. And this was even before I joined Social Capital, but he was on Andrew Yang's podcast. If you just Google Andrew Yang Chamath, he talks about some of the different companies he was looking at, and like one of them was a company that I'd never even heard of this before, but essentially to help with fires, they were deploying like drones over different parts of forests and somehow analyzing like where fires were likely to start or where fires were, and then able to communicate with either forestry teams or firefighters or whatever to go either like pre-burn or help avoid fires or put them out. Just like companies like that are like legitimately making a positive change in the world and people's lives. It's really cool to even be associated with a company like that, No,
definitely. I can see why it's inspiring stuff. So it's great to hear that's going well. It'd be interesting to see where this his founder-led approach to that company, obviously, see where it goes. If he's putting that much time and stuff, you'd expect someone as smart as him to do some really good stuff and see the big returns over the years to come in areas that are helping the world, which is great. I just wanted to quickly move on now to a few questions about the market today, basically, make it a bit more relevant to today. And one of the things that everyone's been on everyone's mind is all this supply chain issues that we're seeing, particularly in semiconductors, etc. What's your opinion on this at the moment? Where do you think it's going to get worse before it gets better? Is it going to be prolonged and we'll have supply chains for some time, or is this something it is sort of transitory and we will get over it?
Yeah, I'm super unqualified to have an opinion on this. I don't know what's going to happen with the supply chain. The thing I look for as an investor is I try to listen to the management teams and what they're saying about the supply chain and whether it's improving or not, of the companies I own, but also of like companies and people that are like directly associated with this, right? And for anybody interested in this, Ryan Peterson, he's at TypesFast on Twitter, is the founder and CEO of a company called Flexport, which is essentially like a global logistics company. He shared out I think this was on Friday, he shared out a tweet thread. He rented a boat essentially in Long Beach, which is one of the more popular ports on the West Coast, and shared some things that he learned. And I mean, I don't know if this is great for podcasts, but here's a couple of the things he said in his tweet storm. In a 3-hour loop through the port complex, passing every single terminal, we saw less than a dozen containers get unloaded. There's hundreds of cranes, counted only 7 that were operating. And so essentially, it seems that everybody agreed that the bottleneck is yard space at the terminals, and that they're essentially like overflowing with containers. And so, he's got that thread there. You can find it. Some of the stats are just alarming. And one of the things he shared out is that like 77% of the world's global ports are seeing significant backlogs. And so I'm no expert in this, but, just in my experience in the military, I know how long it takes for some of these things to get like fixed and flowing. Even when the Suez Canal was blocked, like that caused, that took a while to catch up. And so just from my perspective, like, I think we're going to have supply chain issues probably like through 2022, at least in some capacity. I'm not in a place to predict, like, is this going to cause any type of recession or what it's going to do? But as an investor, like, my responsibility, in my opinion, is to just watch the companies that I own. And then again, like other companies that are large, impactful companies. So like Amazon obviously is going to have good insight into this, and see what the management teams are saying, and then look at the numbers and see what those are doing. But it's another reason why I tend to stay away from companies that are like, highly reliant on imports and consumer goods. And I really prefer like software and tech companies who, DigitalOcean, for example, or that might be a bad example if people aren't super familiar with it, but a Salesforce, for example, there's no physical product that they have to deliver and create and have on shelves in order to make a sale. Their customers certainly are relying on those, so we got to be careful about that. But that's an awesome thing about software companies is it's essentially free to create another license and sell to somebody, or another subscription and sell to somebody. So yeah, and then ultimately it's like, if this does become a major global issue, then it's even more important to own strong companies, that you think are leaders over a long-term time horizon, that, have good balance sheets and things like that, versus just owning something that you don't have a lot of conviction in, that you're maybe just wanting to own for a month or a quarter or whatever, because who knows what's going to happen in a quarter or two. I think, I think they'll figure out a way to innovate and get out of this thing. I have no idea how long it'll be and what's going to happen.
Yeah, interesting. But feasibly, you could predict, and they have been saying, haven't they, in the news, that the run up towards Christmas, because as demand obviously increases, spikes, that it's only inevitably going to get worse over that period before it gets better.
Yeah, and so for me, it's just like, okay, well, what companies are going to get hurt by that? Well, any company that relies on, is like a big box retailer, or even potentially auto companies, who knows, with low margins, that either have a lot of debt or something like that. And I shared out, I think the strong will get stronger, and then companies with like adaptive business models. And so, like, not a recommendation by any means, but a company like Etsy that doesn't own their own inventory, and actually a lot of the people on their platform are creating handmade goods and sending to like their local, within their country, to buyers like within their country, that isn't going to require shipping port to port. they potentially stand to benefit from something like this, because if somebody's not able to order something that they want from Bed Bath & Beyond, they might go to Etsy and look for something similar, and then Etsy can fulfill that, and then they win a customer, and that might be a customer that's never used Etsy before and then becomes a long-term customer. So, there might be some opportunities here as well.
Yeah. Be interesting how, I think Biden's supporting it as well. He's trying to do more US manufacturing. And it's scenarios like this, isn't it, that push forward the timeline of things like this, because if people can't get hold of stuff, there's an opportunity for it to be made locally or domestically.
And even like with, I know we probably got to wrap up, but even with like COVID, right? What we saw with COVID, and this was specifically in kind of like the supplies we needed to specifically to like deal with COVID, was the medical industry in a lot of ways operated on like a just-in-time basis for supplies, and not just the medical industry, but other industries as well. And the reason in the US for that is because we want to be as efficient as possible, and companies are, worried about the bottom line and getting like the max gross margins and things like that. One of the things that Scott Gottlieb, I heard him on a podcast, I forget exactly which one it was, but he was talking about how in the future he foresees, and this was like specific to the medical industry, which is like kind of his area of expertise, he foresees some potential, and not stimulus, but I forget the exact word, but where the government is going to provide some type of like funding for companies to essentially have excess capacity and not run as efficiently as they absolutely could. But then the government would have the ability to say, okay, this emergency happened. We now can use 50% of the logistics or manufacturing capacity that you have to support this national emergency or whatever. So essentially like giving some excess in the supply chain, in this case, the medical supply chain, to then deal with these things in the future. And something like that might end up happening for, just more of like the logistics supply chain. Who knows? Clearly, like we've got to adapt and innovate. And that's what we do, right? That's what the world has done over time. And I'm confident we will at some point for this.
Definitely. I completely agree. We always seem to find a way around it. Well, thanks very much, Austin. It's been great having a chat, a long chat. Like we went through a lot of stuff and a lot of interesting sectors or industries, themes for everyone to look into, as well as this founder-led mentality of investing in founder-led companies, which comes up time and time again. It seems to be something that works really well, and a good thing for people to do themselves, along with this long-term investing point of view, which people often, especially there's a lot of new people in the market, that probably takes them some time to come around to that. You've got to wait for the gains over time to lower your risk and of having losing your money. It's better to invest longer term. And I don't know if there's anything you wanted to finish with, Austin. Where can people go follow your thoughts on the markets, etc.?
Yeah, thanks, Ed, and thanks again for having me. A bit long-winded, I know I am, so I apologize for that, but hopefully was still useful. I'm on Twitter at Lieberman Austin, Lieberman Austin. And then I have a Substack, so I still do a free newsletter that's at austin.substack.com. And thanks for asking me that and let me share. And then like just one last thing on the time horizon thing you just talked about, right? Ben Carlson, he's an author of A Wealth of CommonSense.com, has an article written on October 14th. Time horizon is everything for investors. And it just goes through how often is the stock market positive. And this is from 1926 to 2021. So almost 100 years for rolling monthly returns. Over 1 month, the stock market's positive 63% of the time. And essentially that goes up as your time horizon gets longer. And when you get to 7 years, the stock market is positive 95% of the time. 10 years, 95% of the time. 15 years, 99.8% of the time. And 20 years is 100% of the time. And so that includes, if you look at that time horizon, 1926 to 2021, that includes world wars, I think even the Great Depression, definitely the global financial crisis, 1999, 2000, the dot-com bubble, COVID, all of that. And so just to that point, like, yes, time horizon is everything. I mean, especially if you're just a person saving and doing something like indexing or something like that, like, yeah, the time in the market is everything. And then when we try to like get smart and fancy and time things, it ends up a lot of times just being a waste of money and time. And like, yeah, there's examples of the best investors in the world out there doing that, but probably a lot more examples of people not doing it well that we don't hear about because of the kind of survivorship bias, right?
Yeah, of course. Well, yeah, thanks, Austin. Have a great rest of the week, and hopefully we get a chance to do this again.
Yeah, would love to. Thanks a lot, Ed.
Cheers, Austin.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.
Co-Fruition.